Okay guys, number two is money. Now what do I mean by money? This is an interesting debate actually, and some people have different opinions and different viewpoints on it, which is fine. There's no right or wrong way to do this, but my comments on this might make you think about, a little bit more about your approach. So I mean in terms of how much capital you have to risk in trading. Now the one thing that you don't want to do as a trader, in my opinion, is if you've got a decent amount of capital, and I say decent amount of capital, that's very subjective, but whatever that may be, that number may be, I would advise that you put that all into your trading account in the beginning of your trading career, unless you have a strategy that you need that kind of margin. So in other words, you've got a very high margin intensive spreading strategy, you're pair trading various different things and it's very intensive on margin and you require that, then that's fine. But if you're just trading currency pairs, indices, stocks, or whatever it may be, just put the amount in for the margin you require for what you're going to do. Now, I'm digressing slightly, and I'm going to come back to this point, but the point I want to make here is, how much money have you got to put to work? Because that is going to affect kind of the type of trader that you want to be. If you're not very well funded, then potentially you are going to have to make your money work better for you to make a return. That is quite a broad term, quite a broad phrase for me to use, but if you see what I mean by, if you only have, say, a couple of £1,000 to put into an account as opposed to maybe £100,000, you're going to struggle to hold, a portfolio of swing positions over a year and make that money, kind of work for you. Whereas if you've got £100,000, you can spread that out a little bit better into £10,000 positions, hold those for 6 months, juggle it around, and before you know it, you can make a kind of reasonable amount from that. So if you've got a smaller amount, you're going to have to be a little bit more active, a little bit more aggressive, take on a little bit more risk, potentially, if you're looking for the bigger returns. Obviously, if you're looking for a smaller return on that couple of £1,000, that's fine. But my guess is if you're here watching this, you're looking to make a little bit more than that. So you're going to have to take on a bit more risk and be prepared to dial things up a little bit more. So that may mean that you have to take bigger positions than perhaps the textbooks say, just to reach your monetary goals. You're going to have to be prepared to make some, have some drawdown on that and prepared to wipe that out completely, which is kind of where it comes back to my point of, if you have, let's say you're starting out with £20,000, and that could be 10, that could be 5, it doesn't really matter. The amount of money is pretty much irrelevant here. But let's say that's the sort of starting capital you've allocated to trading. My recommendation would be, and again, this is purely how I would do it. This is not personal advice at all. Everyone's circumstances are individual. Insert disclaimers here. You know the risk of this game, guys. I hope you do, but I'm pretty sure you do. So 20,000. Let's say you probably put in, kind of 5,000 or 2,000 or 3,000, something like that. Right, and that's what you'd start to trade with, and you'd prove to yourself that your strategy works by employing that, putting that 3,000 to work, and saying, okay, I want to try and double that, or perhaps 50% of that, make 50% on that in the 6-month period. That's kind of the rules that I work with. Other traders are differently. Some people are more aggressive, some people are less. But if you're putting the work in from a day trading perspective and being far more engaged with it, you kind of need to have the reward that comes with putting that time in. So let's say, in 6 months' time, you want to make that into 4.5K. That's really what you've got to prove to yourself before you start to employ more capital. Because the trouble you have is when you're starting out trading is that you may well want to employ all this capital, and you may say, okay, well, if I can double that in my year, that's 40,000, whatever it may be, I'll take this out, that out. But you tend to overlook the fact that in actual fact you could turn that into 5 just from in a bad conditions, bad market, or just trading badly. So employing a small amount of capital at the start is kind of the best way to do things, in my opinion. But obviously, you need to look at your own circumstances and employ your own risk parameters that suit you. But anyway, going back from the perspective of the type of trader you are, so the money that you've got to trade, if you've got a larger sum, generally speaking, you're open, you can do some more swing trading stuff, because you don't need to be leveraged so much. You don't need to have that much volatility in your positions, in your trades for you to make money. You know, you can make money from a swing trading position. So that opens up a lot more opportunities to you. Now, it doesn't mean to say you can't swing trade if you've got a smaller amount, but if you're looking to kind of make that money work for you more aggressively than you would with a passive investment, then, you know, you're going to have to be a little bit more, dial things up a little bit more. So money. So in other words, you know, funds at risk. And the other thing which I haven't talked about is how comfortable you are with losing that money. Do you know, this comes back to the point of managing risk and how you perceive risk. If you're going to put in 5,000 into one swing position, the likelihood is, if you're picking in a reasonable stock or an index or a currency pair, you're not going to lose that 5,000, right? Possible, but likelihood is you're not going to lose a 5,000. However, if you were to put that 5,000 into 10 trades risking 500 each with a stop loss at £500, it's very likely you'll have 10 losers and you'll lose that 5,000. So understanding not only what capital you have to employ as risk capital, and remember, in trading, guys, always view capital as a tool. It's not a case of building it, it's a case of using it as a tool to make more, but also understanding how much you're prepared to risk that capital. If you're prepared to put it all on risk, then the rewards and the losses are equal. You know, you're prepared to make a lot of money out of it, compared to lose a lot of money. So it's your financial situation, how much money you're prepared to risk at trading, i.e. the funds that you can employ as trading, the funds that you're prepared to risk, which can be different from the total capital you've got. Going back to that previous example, maybe you have got 20,000 to stake at trading, but you only want to risk 3,000 in this 3-month period or whatever it may be as you're learning. Understanding that and then saying, okay, well, that means that I perhaps am going to swing trade with the other 17,000 or another 10,000 and put some to one side and just swing trade that with smaller size to kind of nurture that. But I'm going to be more active with a smaller amount of money, be more aggressive to try and push me towards my trading goals a lot quicker. So appreciating how much money you've got, how much money you're prepared to risk, accepting that risk as well. I talk about this a lot in other videos, and are constantly talking about accepting the risk on it. So not going into it without your eyes wide open and saying, listen, I could lose this money. Am I comfortable losing this money? Yes, I am. Then carry on. Okay, so that's really important. Next one I'm going to look at is personality. Let's move on to personality.